Good morning everyone. My name is Matthew Mims from the Investment Store and I'm delighted to welcome you all to this latest monthly investment briefing from Devon and featuring Portfolio Manager Tama Willis. In today's briefing, Tama will examine some of the current key geopolitical issues playing out, discuss their possible implications, particularly for markets and economies, update you with some current thoughts on the state of play in local markets, and finally comment on the current positioning of the two Devon strategies that he runs, the Trans-Tasman Fund and the Australian Fund. This session will last for approximately 15 minutes, and we will also allow some time at the conclusion for any questions that you may have. And you can type these in to the questions box as we go along, which should appear on your screen. A quick reminder that this session has been designed for wholesale clients as defined by the Financial Advisors Act. Before I pass you over to Tama, very briefly, here's a performance update on Devon's 4 Australasian equity strategies, updated to the end of July 2016. The figures are net of fees, but before tax. And as you can see, a strong month for local equities, and the various Devon strategies continue to perform very solidly in absolute terms and against their relevant benchmarks over the vast majority of time periods, in particular the 1, 3 and 5 year periods. Okay, so it's now my pleasure to pass you over to Tama.
Thanks, Matt, and thank you everyone for taking the time to call in today to hear the an update on the investment markets and the Trans-Tasman and Australian funds that I run. I'll just move on to slide 3, and we'll start with a bit of an update on the global economy. We are clearly in a period of some uncertainty, and that's translated into some of the growth numbers that we're seeing around the world. And recently the Brexit vote, where the British public unexpectedly voted for leaving the EU, that was a surprise, but the markets have taken that somewhat in their stride, and I think that partly reflects the FTSE 100. Around 80% of FTSE 100's revenues are outside the UK, so the 10% fall in the pound has really helped there. And also the quick succession of the UK government, the change in the UK government to a fairly strong leadership in Theresa May, and also the likelihood that it could take up to 3 years before the full Brexit terms are negotiated, if indeed they ever are negotiated. Now those are all questions that are occupying the landscape. In terms of the next, I suppose, focus will be the US election, where Donald Trump and Clinton are neck and neck in the polls. And that's still, we'll hear a lot more about that in the coming months. The markets overall seem to have been climbing a wall of worry, and some cautiousness around the economic environment hasn't stopped markets from making new highs in many cases. Global economic growth, you see GDP growth on the left-hand chart. Nominal GDP growth around the world is one of the weakest it's been in a long time. And that's been showing up in terms of some of the bond yields that we're seeing around the world, negative rates, a lot of government debt. Japan, Germany, as investors look for safety, have been trading at negative yields, and we have a number of interest rate decisions that will be very closely watched by the market in the coming 2 to 3 days, with the Reserve Bank of Australia today. The Bank of England will make its decision on both interest rates and whether it's going to embark on a new round of quantitative easing on Thursday, and we have the RBNZ next week. So quite a lot of interesting central bank announcements ahead of us, I suspect. In terms of Australia, Australia, I think we've had an unstable political environment for as many years as I've been running this fund, if not longer, for the last 5+ years, where there's been regular changes in government, changes in leadership, and the latest election, which took place in early July, has no difference. So we had a lot of uncertainty in the week after the election, but the Liberal Party coalition came away with 76 seats, so had sufficient for a majority and ruling in its own right. There are 150 seats in Parliament, in the House of Representatives. Subsequent to that, they may have lost 1 seat, but that is unclear. But Turnbull has taken power. He has support of a number of minorities, and whilst it's still somewhat uncertain, the Australian public have learnt to deal with that. So we've seen consumer sentiment a little bit weak. We've seen some talk of inquiry into the banks, although Turnbull has rejected that to a large extent, and we've also seen Australia's sovereign credit rating, its AAA rating, put on negative watch unless the government really comes in and adjusts its spending targets. So we're still going through that in terms of the election. The final votes, are still playing out, but at this stage, it certainly looks like Turnbull has support to govern in his own right, but it is a very thin majority, so we need to keep that in mind. In terms of slide 5, we look at the Australian economy. It's managed despite all of the uncertainty and all of the weakness in commodities and the capex downturn we've seen. Australia's continued to grow between 2 and 3% GDP growth. More recently, consumer confidence has been weaker, while business confidence, those companies in the economy, have actually shown improved confidence. Now, why have we seen that? Partly on the business side, the Australian corporate sector is in good health, relatively good health, strong balance sheets, and certain parts of the economy are benefiting from very strong house building. We've seen very, very strong tourism inflows. We've seen strong house prices. We've seen commodity markets improving recently. We've seen finally the manufacturing sector just picking up at the margin, finally responding to a weaker Australian dollar against the US dollar, even if it has picked up recently. Whilst consumers wage growth in Australia, so inflation and wage growth has been very low, and there has been, whilst house prices have continued to go up, there's been some nervousness around the outlook for housing markets, similar to what we're seeing in Auckland, prices going up, but nervousness around it being an overheated market. So consumers have been a bit more cautious on the outlook, and we've done probably 4 or 5 trips to Australia in the last 2 months, seen over 70 companies, and it just very much depends on which sector of the economy you're in, depending on how you're feeling as a company. The commodity markets are very interesting that they have rebounded to a certain extent, ranging from thermal coal, even dairy, a slight rebound. Oil has picked up, although it's retraced sharply in recent weeks. And that part of that has been driven by the Chinese government's desire to maintain their GDP growth above 6.5%, and fixed asset investment, that's investment into railways, into airports, roads, by the government's picked up very strongly and running at over 20% year-on-year growth. Private sector fixed asset investment has actually been much weaker. So it does present a risk for commodity markets if the government support ebbs, which I personally, whilst I don't see Chinese GDP growth slowing materially, I expect that real push to ebb in the coming quarters, and we've maintained an underweight in the resources sector, although it is less than it was at the start of the year. In terms of the New Zealand interest rate settings, we've got the RBNZ obviously reporting next week. Futures markets are implying a cash rate below 2%, so that would be another cut in the coming periods. Inflation is obviously very low, but there are parts of the New Zealand economy that are going well around tourism. Net migration is obviously very strong. Similar to the RBA, the market is looking for interest rate cuts before the end of the year. And I suppose we look at, Matt mentioned the performance of New Zealand and Australian equity markets in recent times, and if this is a very interesting chart which just shows that New Zealand and Australian dividend yields are well above the rest of the world. New Zealand's outperformance has led to its yield compressing, and Australia sits clearly higher than New Zealand at this point. And given interest rate settings and bond yields around globally, these markets have attracted further interest from foreign investors given the recurring yield. Slide 9 shows the performance of the market, the Australian market in 2016. New Zealand obviously outperformed Australia and has done for 5 years, but the Australian market, including dividends, was up 1% last year. But what's interesting, if you look along across the various subsectors in the market, infrastructure, REITs, you're up 25 and 41%. Right at the other end, we had banks, energy, and metals and mining. So this remains very much a stock pickers market where you look for individual companies that are going to do well in a certain environment, and that's allowed us in a number of strategies to outperform the market. And the second chart really tries to show that high earnings. There are companies in Australia with very high earnings multiples, and they've generally been bid up further. There are still a whole range of companies that are trading at relatively low multiples if you can get around some of the risks, and we're still finding companies down in that band with lower multiples that are attractive to bring into the portfolio. So it's very much a stock pickers market. If we look into 2017, this shows the Australian ASX 200 earnings consensus, and what typically happens as we go through the year is positive estimates by analysts in Australia will be cut as we go through the year. We don't think 2017 will be any different. We'll expect some earnings reductions as we go through the year. What's been interesting is as we move into the reporting season, which takes place over the next 4 to 6 weeks, we haven't seen too many downgrades ahead of the reporting season. So that could suggest that that reporting season may be better than last year, which would be good for markets. I've just shown here the snapshot of both the Trans-Tasman and Australian portfolios at the end of the month, and I think we're still finding still fully invested. We have around 3.5% in both strategies. We're finding good ideas to have high conviction positions in across the portfolios. We've travelled to Australia a lot recently. We feel like we have a good understanding of where our businesses sit, and if we look at the TT and Australian funds, both have around, TT has around 35 stocks, Australia around 32, and Trans-Tasman really takes the very best ideas from my Australian portfolio in terms of high conviction ideas. In terms of my sector positioning, now we really don't look at it like this. We really just focus on the individual ideas and then build up a portfolio from a bottom-up perspective. The ASX 200 is somewhat different to the New Zealand market. It is dominated by banks at about 28% of the index, resources and industrials, whereas New Zealand is dominated by utility sector, telecoms, healthcare, and REITs. In aggregate, at this point, we're overweight consumer discretionary, and I'll mention a number of those ideas at the back of this presentation. GTN Media is also mentioned there. We are overweight infotech, which relates to the Vista position, which we're still very excited about. Made an important announcement yesterday on part approval of their Chinese deal. We have moderate cash positions. We're overweight utilities, healthcare. So we've been conservatively positioned through this recent market upheaval, but we've still managed to perform in line or ahead of the market. We're still underweight banks, materials, industrials, and staples. REITs we've moved slightly underweight, having had some excellent performance over the last 6 months in Westfield, Centre, Stockland. So we're still very comfortable where we're sitting in terms of portfolio construction, in terms of ideas in the funds, and I thought I'd just run through 2 of the investments that we have in the funds at the moment, but happy to talk about any of them, obviously, and we have mentioned quite a few of them in past webinars, like Vista, like Media. GTN is a recent addition to the portfolio, and what really attracted us to this company is, if you look around the world, obviously advertising markets and TV markets, media markets are under huge change, and you'll see that from our own viewing patterns with Netflix against Sky, with looking at using Facebook, using Google more. So advertisers are looking at new mediums to get their message out to consumers. Where GTN sits is in the radio market. So radios represents around 10 to 15% of all advertising, and GTN, given the example of its Australian business, essentially it provides traffic reports to radio networks. So it has 20 helicopters in the air. It's providing radio reports, news reports to radio stations in exchange for ad slots, 10-second ad slots around that. The traffic report. So an advertiser like Coles is then able to place an ad about banana prices or a banana sale or something like that across the whole of the Australian radio network, because GTN deals with all the different radio stations in Australia. It's able to do that and gets a very good price from the advertiser because it has 100% coverage across Australia. if you look at the chart to the right, it's been able to grow its earnings since 2003 very considerably as it's built its scale across the whole network, and it has a very, very dominant position. It also has a business in Canada, which is about seven years behind Australia, another business in Brazil, and the US is an area it's looking at expanding into. So at its valuation and its growth profile, it looks very attractive. It has the hallmarks of one of our other investments we've talked about in the past, which is oMedia. oMedia is in the digital advertising space, so it has billboards, which you'll see if you go out to Auckland Airport. You'll see the digital billboard. Now they're digitising from static billboards. They're digitising right across Australia. They're digitising in all the shopping malls. You see digital screens now, not fixed screens. And as given the decline in television viewership and television advertising, advertisers are really shifting to outdoor. And GTN is also not covered by many analysts. It's not well owned across the market. So we think over the next 12 to 24 months, it will become more highly rated, and its earnings will grow above expectations. In terms of Spark is another really good business that's been performing very well for us right across all our portfolios. It's a regulated utility business. It has investments in power networks across Australia, South Australia, Victoria, Melbourne CBD, and the recent regulatory reset has occurred, so we have a lot of certainty over the next 5 years, and that's allowed it to increase its dividend profile. When we acquired this investment, it was yielding 7.5% dividend yield. After a 25% rally, it's now yielding 6%, but the dividend growth profile is very good. And in this uncertain world where cash rates are almost zero in many parts of the world, you have absolute certainty of earnings growth, and you have a 6% yield, and that's been performing very well for us. An example of one of the defensive businesses still outperformed significantly in a rising market. So I'm really happy to open up to questions. In summary, we're still finding new ideas for the portfolios. We feel good about a lot of the positions that we see at the moment.
Okay, so we've got time for a few questions, so do please type some in if you have any. First one, Tama, how exposed is the New Zealand Aussie banking sector to a crash in the Auckland housing market, and B, further stress in the dairy and farming sector?
Thanks, Matt. That's a good question and a difficult one. So I suppose if you look at the bank's balance sheets and you look at how exposed they are to New Zealand, most of the New Zealand banks, Westpac, BNZ, ASB, and ANZ have around 10 to 20% exposure to New Zealand. ANZ 20%, the other banks are roughly 10% of their earnings from this part of the world. In terms of their books, a portion of that is housing, and then a portion of that is commercial lending. I suppose it depends very much on what we mean by a crash. If it was a 10 to 20% decline over a period, that would be manageable. Obviously, a much bigger correction would start to be more difficult, especially if it was accompanied by a large tick up in unemployment, because that's what in Australia we're seeing very high, very high house price growth as well, but we're seeing unemployment stable, and we're seeing interest burden on that debt obviously declining, and that's happened in New Zealand as well. So it would need to be accompanied by a pickup in the unemployment rate. And I think Australian housing is just a far bigger part of the balance sheet, 50, 60% in some cases of the balance sheets. So that is a bigger concern. In terms of our positioning in the banks, we're underweight. We have been for 12 months, ranging from 5 to 6% across the portfolios, and that really reflects our inability to answer the question around the extent to which bad debts could pick up if housing weakens. Dairy, we still think there's some risk there. Capital rates probably need to go higher for the banks, and despite what look like attractive PE valuations, we just feel there's enough uncertainty to keep us away, a bit away from the sector at this stage.
Just a question on foreign ownership. percentage of foreign ownership of the NZX 50, and any general comments on trends, foreign ownership of New Zealand equities.
Yeah, I mean, it has definitely picked up in recent years quite markedly, and Australia has historically been has been around recently, be around 46%, and New Zealand has come up towards that level, and that reflects partly the attractiveness of the New Zealand dividend yield, and there are some businesses in the New Zealand market that do look overvalued. So that's certainly picked up more in line with Australia in recent years. Now, in terms of looking at the outlook and looking at valuation, New Zealand trades at around a 20% premium to the ASX at this point. New Zealand is trading around 20 times earnings, the ASX around 16 times. One thing we do need to remember, though, is that stocks like Auckland Airport and Fisher & Paykel Healthcare, my funds are underweight both of those stocks at this point, are traded around 35 times earnings, so that lifts the market PE. You've also got good utilities in New Zealand that have high depreciation rates and trade at quite high PEs, which also lifts the market multiple of the New Zealand market. So it's not the premium's not as big, maybe, if you stripped out those businesses as it appears. I suppose over the last 6 to 9 months we've had more New Zealand exposure over Australia, and that partly reflects we've found some good ideas in New Zealand, but also our conservatism on the banks, and increasingly we're finding more ideas in Australia than New Zealand. So if that trend continued of New Zealand outperformance, I'd expect the fund weighting, which currently sits around 49% in New Zealand, a little bit less in Australia, may switch the other way given that idea generation.
Look, I think we've just about run out of time, so what we'll do is wrap it up there. And look, thank you very much, Tama, for taking the time to prepare today's presentation. Thank you all for taking the time to listen in today. We will send a follow-up email out shortly with a copy of the slides. And we have also recorded this session, so if you do want to listen to a playback, then please do let us know. So on that note, thanks very much for your interest and have a good day.